of the all-important QQQs, the Nasdaq 100 Index Tracking Index, and we're looking at approaching a price level of resistance here at 52.80. So, that's, let's see, it went out at 49.98 yesterday. That's a little over 280 to go. We could see that, I believe, between now and maybe the first week in January or the second week in January. But then I also don't see much upside in that. The four companies that have been carrying the Nasdaq continue to do so, with RIM last Thursday coming out with better than expected earnings on 12/20, 65 cents versus 62 cents, and of course that led to everybody raising their targets on the stock. Looking forward, stock added about $12 that day, and I will pull up RIM to show that. Okay, zoom in, and there we see the gap up on RIM. Like I said, one of the main suspects of the Nasdaq strength. The other three being Google, Amazon, and Apple. Apple also showing some strength yesterday, adding almost $5. If we can go back to a chart of the spiders, I think it may be interesting to point out the low volume that we saw the last 2 days on those up days. We could be looking at just a little bit of market manipulation, a little bit of window dressing. Of course, there's a lot of theories out there for why we see this end of year buying in such would appear to be a weakened market environment. If I can continue on, last week, as I said, was a quiet week for economic data. This week, and it appears as though we really have put the Fed on the back burner for a while, the recessionary fears now, and add in the inflationary fears, and we pretty much are looking at that term stagflation, which was thrown around by former Chairman Greenspan last week in a speech that he made, which is not a very favorable scenario for bull positions in this market. That would mean recessionary environment with continued inflation levels. And we can see with crude going out at $94 yesterday that the $100 level is still in play, and the dollar remains very cheap and very weak globally, and recession seems to be the order of the day. Looking forward, this week from macroeconomic data, we're looking at 8:30 on Thursday. The durable goods order will be released with a 4.0% expected number, and then on Friday we're looking at the Chicago PMI manufacturing index with a 52% expected, just slightly expansive, with 50% being neutral. If either of them tend to be recessionary, I think at this point, with the Fed already tipping their hand as far as their fear of inflation and oil continuing to be in the mid-90s, recessionary data no longer looks to be bullish because the Fed has already, in my opinion, as I said, kind of exposed themselves to the fact where they are looking at inflation as well. So I don't think that it's the environment to where you can think that the FOMC is going to blindly come out and infuse capital and liquidity and or cut rates to devalue the dollar further in order to prop up the market. So once again, we see recessionary this week, and you could see some more downside a little bit quicker than you think, which could impinge upon that usual annual rally at the end of the year. Okay, that's basically all I have to say for this week. Let's keep an eye on our technical levels here. As we see, the spiders are right at the 200-day moving average. And Over on the technology side, we're right at the 50-day moving average. So, once again, there's not any tremendous technical levels that are being breached at this point, and it's difficult to continue to have a bullish sentiment here. So once again, this is Greg Wolf from Options University, and I will talk to you next week.